During our meeting in August, we had projected some growth which was much more muted, but this time around we see that the prospects are much brighter. We see that the financial sector continues to hold its own, and we see some progress being continued to be made in fiscal consolidation. So we looked at these factors as we made our decision. Now let's look more closely at inflation outturn. What we note is that inflation pressures have persisted since the last MPC meeting in August. Inflation rose to an average of 11% in the third quarter from 9.9% in the second quarter. And in October, we saw that inflation on month increased to 12.6% from 12% in September. In terms of details, we have this table which we normally share with you, which is divided into two parts. There's the first part which looks at the average, and the second part, which is below, looks at the end period. So if you cast your eyes on the first row after the description of the variables there, where we talk of overall inflation, you see that in Q2, or let's say from Q1, inflation was 9.6, which had been a decline from the previous quarter. We see that in Q2, 2023, inflation rose to 9.9%, and in the third quarter that we are focusing on, inflation rose to 11%. Now, if you look at the components, both components, that's food and non-food, were both rising. For the food, it rose from 11.5% to 12.7%, and non-food rose from 7.9% to 8.8%. From the end period perspective, we see that inflation closed the second quarter at 9.8% and closed the third quarter at 12%. If you go into the components again, you see that food inflation rose to 13.4% from 11.2%, and non-food rose to 10.1% from 7.8%. So all this is showing that inflation is moving away from the target range of 6 to 8% that we are aiming for. Higher food prices are largely driven or mostly driven by maize and its products. I think this is a story which you are all familiar with, but this is coupled with the increase in fuel prices. Depreciation of the kwacha against the US dollar also has been a cross-cutting problem for inflation and pressures that we are facing. Constrained supply, and due to adverse weather conditions, climate change that is, amid high regional demand, largely explain the sustained rise in maize grain prices. As for the increase in fuel prices, we see that, as ERB always informs that there are two main factors that they look at. One is the price of fuel, the crude in the international market, and what is happening to the exchange rate here domestically. So both elements have been going up, which obviously informed them to adjust the price of fuel at the pump. And that obviously has cascading effects to the rest of the economy. This part which I just described is what has happened, that inflation has been going up. But we also look at what are the projections of inflation going forward over 8 quarters, which is the period over which we forecast, what we note is that the inflation forecasts are showing that inflation is moving away from the target range, as it were. So this is what we see here. If you look at the small table on the right-hand side of the screen, there are 2 rows there which show the Q4 projection and the Q3 projection. The Q3 projection shows that our projection in August was that inflation would move to 10.2 in Q4 2023, 9.3 in 2024, and 9.3% same level in 2025. But this time around, we see that inflation has actually moved up. For Q4 this year, it's projected at 13.1%. It comes down somewhat in 2024 to 11.4% and further down to 9.6%. But you see that all the numbers in the row above are higher than what they were in the second quarter, which shows that we are above the target range, which is what is being depicted on the left hand of the screen. The brown bar there is showing you what the target has been. And you can see that the projections are showing inflation being well above that brown bar. And that's our concern as the monetary policy, and consistent with the mandate that the bank has, which even the colleague who was making the prayer did refer to. It's price and financial system stability. So we see that there is this sustained pressure on inflation, which we must deal with. Otherwise, inflation becomes anchored at higher levels. Now, in doing this, we are alive to the fact that there are trade-offs that we have to make. It is painful, but it's a necessary evil, because if we allow inflation to continue to rise, we will end up eroding even the benefits that we have so far made. Just to preempt a question which might be coming, people say, why are you doing this? Isn't this contradictory to what the Ministry of Finance is doing? To the contrary, if you look at the budget speech, you will note that there are macroeconomic targets that the minister has outlined. In each budget speech, the minister outlines targets that must be met. And one of those key targets is inflation. So the target is given there. So how else can we move into that target or stay within target is by taking action such as the one we are taking. So it's consistent with that expectation. All the variables are supposed to hold together for the economy to move forward in a stable and sustained manner. Now, the effects of tightened global financial conditions, I think this is a matter which we have talked about and others have talked about, that in the global markets, we are now in a new era of raised interest rates and tightened monetary policy. That has had spillover effects on our economies. Now, these often show up through the exchange rate and the expectations. When these movements do occur, people make adjustments to how they behave, how they act out in the economy, and that has impact on what is happening in our market. Elevated food and fuel prices are expected to drive inflation during this period that we are forecasting and push it further away from the 6 to 8% target band that we talked about. The build-up in geopolitical tensions, including the protracted Russian-Ukraine war and the recent Israel-Hamas war, further tightening in global financial markets as inflation remains elevated, and weather-related shocks are key upside risks that we are highlighting. In other words, there are all these pressures that could still impact our inflation and our economy adversely. Many of those obviously are outside of our control, but we have some which is under control, like the food. I think that's something we must do. And this is the rain season. We hope that we can respond to that in the coming season. Turning to the foreign exchange market, which is underpinning all this, I think, colleagues, you recall that other people have said that when there are imbalances in the economy, the exchange rate is one of the barometer tests. That's one which will tell you things, are they okay or not okay? Clearly, in our current environment, things are not okay in that there's this imbalance. So what we note is that in the third quarter, the kwacha depreciated by 5.8% against the US dollar, and the pressure has persisted in the fourth quarter. Between end September and November 21st, which was yesterday, the kwacha depreciated by 10.9% to 23 kwacha 30 ngwe per US dollar. Cast your eyes to the chart on the right there. What you see, we have drawn a line there to show the period we are focusing on. You see that all the line graphs there are showing movement upwards, which is showing that the kwacha was depreciating against all those currencies that we are depicting. Look, the red, that's the Zambia, the kwacha, and the US dollar. The green, that's against the South African rand. So you can see that whereas not so long ago, we were at par with the rand, but we have surpassed that. And these movements in the currencies, I'll show you later what is happening to other currencies as well. But what we are saying is that the kwacha has been under severe pressure. Why this? Well, for us, we see that there has been sustained excess demand for foreign exchange in our market, mostly by the energy and the manufacturing sectors amid low supply, especially from the mining sector. And the other factor is obviously the strengthening US dollar. As I said, we'll come to show you the movement of the dollar, all the other currencies vis-a-vis the US dollar. So in our case, the kwacha has also moved in tandem with that rising strength of the dollar. Now, we haven't sitting idle by to watch the situation just deteriorate. We monitor volatility. The rates that you see posted, they already take into account some of the actions that we do to moderate that volatility. But sometimes that volatility is such that is so strong that even the moderating actions that we take are kind of overwhelmed. So what we are saying is that to moderate volatility and help meet some of the critical imports, because if we did not do that, you would probably have fuel shortages here, you do not have some of the medicine that you need, would not be current with our debt service. So we have to do what we need to do to ensure that the economy is facilitated to move forward. So much of the firepower we have had to do that has been facilitated by purchases from the market, notably from the mining companies in the form of mineral taxes, but we'll come back to that a little later. Now, in the third quarter, what we are saying is that we sold a total of $173 million against the $256.4 million that we received as mining taxes. So the chart on the right-hand side does give you that information graphically. You see the blue part of that chart is showing the mineral royalty. You can see that that improved a bit, but not by how much. Then you look at the orange, that is the non-mineral royalties that you are getting. What the story is showing here is that all these elements are much lower than what they had been in the past. And that's one of the reasons why we are having the pressure that we are having in the market. Now, we recognize that we don't have sufficient, and you will not have sufficient foreign exchange to defend their currency. No country can do that. I dare say that even bigger countries, they don't do that because you are taking a losing battle, especially for a country like ours, which is a small open economy. The demand that you see is in two parts. There is the domestic and the external. The kwacha is visible everywhere. The dollars, they see them. So if we tried to say we want to defend the currency, that would quickly be dismissed by the market because it will be overrun. So that's why, as a country, we adopted the flexible exchange rate to take some of that pressure from the economy. Now, you have seen in recent past, other countries have had to actually do manual interventions by devaluing their currencies to align to the new levels. Now, one way to tell whether the currency is misaligned is the emergence of a black market. I want to find out from you here if you are aware of any black market trading which is happening here. That gives you an idea that the currency is aligned. Yes, there are pressures, but people are still going through the established channels to obtain the currency. In addition to these sales that we made to the market, we had to raise the statutory reserve ratio. We did so on November 13th, where we raised it by 300 basis points. But it looks like that did not have the intended effect. We therefore had to revisit that measure, and we came to the conclusion that additional adjustment is required. Therefore, last evening, we did send out a circular where we raised the statutory reserve ratio by another 250 basis points, and it now stands at 17%. The effective date for this to allow the banks to make the necessary adjustments will be next Monday after we have had the Government Gazette notice published. So all these are extraordinary measures we thought were necessary to address an extraordinary situation that we are facing. People may say that, aren't you making things worse? Well, our view is that the situation which we are experiencing is not a good one anyway. So we can't just watch it because it will deteriorate further. So we have to take these measures and review them as time goes by so that we can make adjustments as the situation dictates. Further insights on the foreign exchange market is that you know that as we are doing all this, we do have an ECF arrangement that we are implementing since last year in August. So under that, which I'm sure you must be following, those who are interested in the subject matter. There are a number of targets that were set, which we must observe, one of which is reserves target. So we have had a target of 3.3 months of import cover. So to be consistent with that, we couldn't sell all the dollars that we got. We had to put some of those in the reserves. But we also note that after the first review of the ECF, following the official creditors pronouncing themselves that they'll provide financial assurances by also moving us to getting the MOU, we received the second disbursement of the ECF funds. So that helped also to augment our position reserves. We have had other inflows in the form of loans that the government got, but must stress that during this period, we haven't had really large inflows to help meet some of our requirements. Now, the delayed restructuring that we have been talking about has had also an impact in the flows that we're expecting. So these are some of the challenges that go with that. Yes, there's a delay, but on the ground, we are still expected to meet our side of the bargain. And we have done so, as you heard yesterday, day before yesterday, when the IMF announced that we reached another staff level agreement, signifying that the ECF program is following the targets that we set. So all that has important implications for the period ahead. So we have to continue doing our part that we need to do. Each one of us has got a role. Ours is to look at price and financial system stability, as well as to manage the reserves of the country. Reserves rose to $2.9 billion at the end September, which represented 3.2 months of import cover from the 2.9 months of import cover at end June. Okay. Now, I said earlier that you'll come back to see what is happening in other parts of the world. What we are seeing is that the current global economic developments have also had adverse effects on domestic inflation. Global growth has remained subdued, and inflation in the most advanced economies is above target despite some moderation. So these other countries, they are doing exactly like what we are doing here to look out for their economies. And when they do so, the big economies, unfortunately, they are spillovers to us. What we are seeing is that there are these reverse flows in the way of portfolio investments, but because we are also dealing with the restructuring, we have had to put a cap on the participation of non-resident players in our domestic market. So that constrained the flow of resources that could have come had that not been the case. So with that, we see that the tightening in these other countries is having these adverse effects. And the projection or the outlook is that we are now in what may be termed as high interest rate era. And this is likely to continue for some time. So we may not have seen the last of the tightening that has been happening in many of these countries. But we are following these discussions and the interactions very closely to forearm ourselves. So now, as these financial conditions have been tightening, what has been happening is that to most major emerging economies and developing economies, which include us here, our exchange rates have come under severe pressure. So the chart on the right here is what is showing how some of the currencies that we picked to show what is happening, that there are others who have had some appreciation, but the great majority of countries are facing exchange rate pressures. On the chart there, you see that at the countries we are highlighting there, you have Nigeria there, the Nigerian Naira, the Angolan Kwanza, followed by the Turkish or Argentine peso. Not long ago, I think we have cited Argentina and Zambia as having the worst currencies, but that's the nature of the times. Then you have the Turkish lira, you have the Russian ruble, Zambian kwacha, the Kenyan shilling, Tanzanian shilling, so all the way to the Egyptian pound there. Then you see the South African rand has kind of crossed, it has picked up, as well as the Brazilian real and the Mexican peso are the ones which are showing that they strengthened. So the message is that we have these pressures which are not unique to us, but obviously we can't get consolation from the fact that others are not, because we are all uniquely affected. So our domestic circumstances matter a lot to us, and we have to do what we have to do, just like others are doing what they need to do. Domestic economic outlook. I did say that the prospects now are much brighter than what they were a few months ago when we spoke to you. So you see the chart on the right, the dotted lines there are showing focus by different groups, and you are seeing all of them without exception, they are showing some growth picking up. Some obviously more conservative than others, but the best message is that the prospects are good. Like I said now, when you say, but you are doing this, no, we want that to continue in a robust and sustainable way, because if we don't address inflation, it's a matter of time that will also get eroded. So we are at a point, especially that we are completing the restructuring process. There's rating upgrades that are likely to happen, because so far the credit rating companies have not revised their ratings for the country, and that is standing in the way of some of the players who could have played a role in our economy. But we are now looking at the prospect of this happening, and that should enable those who are sitting on the edge to come in and make their investment. So we are calling on all the economic agents to do their part in taking advantage of this. The information we get when we interact with others is that they are looking at a bullish situation. Now, the question is, will we be able to take advantage of that? If we don't, then it will be just like something, a passing phase. Will remain talking about potential again. So it's time we put into action some of those plans. If there were any, if there were not any, we must develop some very urgently and start to implement. To conclude, just reiterate that the MPC decided to raise the monetary policy rate by 100 basis points to 11% due to current and projected inflation moving further away from the 6 to 8% target band. The committee judged that if left unchecked, inflation could become anchored at above target levels, thereby making it harder to achieve macroeconomic stability. Therefore, in the environment we have found ourselves in, a much stronger policy response is warranted to anchor inflation expectations and bring inflation back into the 6 to 8% target band. The committee also considered stability in the financial sector and sustained progress on fiscal consolidation in arriving at its decision. The positive spillovers from reaching a staff-level agreement on the second review of the IMF Extended Credit Facility on November 20th, 2023, and the progress on external debt restructuring are essential for macroeconomic stability. Decisions on the policy rate will continue to be guided by inflation outcomes, focus, and identified risks, including those associated with financial stability and external debt restructuring. The bank stands ready to take appropriate action should inflation persist above the 6 to 8 target band.